us a bit of a sense of what's playing out in the power transformer space. But Manish Sonthalia joining us, Director and Chief Investment Officer, MK Investment Managers. A good time, if at all there is any, to get him on board and get a view from Manish, because he understands macro, he understands markets, and he understands India ever so well. Manish, great having you. What should one do? It's a very tricky environment, Manish. Very good morning to you. Very tricky environment. What should one do?
So I think, the directional view is that the conflict will widen first, then it will shift into a longer phase of economic compression, forced adjustment, and selective repair rather than a broad-based recovery. I think the solution which we, and obviously the markets are looking at, is not a diplomatic sort of a situation, settlement. It is more likely a military sort of a settlement. So it's no longer just a geopolitical event. I think it is manifesting itself in, high increased oil prices, LNG and freight. It is now an inflation adjustment event. Supply chain dynamics have got disrupted, and the growth shock is moving through the global economy. So as far as India is concerned, we should be looking at a selective repair. And I think whenever this war ends, 2 weeks or 3 weeks, it's going to take a lot of time for repair to happen, particularly to economies which are dependent on oil. And India is obviously one of the countries which is heavily dependent on oil. And if we are in through an inflationary shock, which trickles down into the system, then obviously consumption suffers, and government has to increase fiscal deficit and all of that. This is going to take at least till the first quarter of FY27. So basically, the whole of FY27 likely is getting washed out in terms of pricing in the negatives. And markets will look forward to FY28. This is how I believe this whole thing is likely to play out, because there's significant damage to energy infrastructure. The Strait of Hormuz, where 40% of global oil supplies move. I mean, that's a vulnerable point, and obviously India is going to feel the pain of it also, as through other parts of the world. But economies which are dependent on commodities, because inflation is now too set on the entire globe, and countries which have a leverage on commodities, they are likely to do better rather than consumer of commodities. So I think this is how likely it's going to play out.
Manish, I just want to give you that bad news that we're already at 21,000 thereabouts. We've dipped that 22,000 mark, and we just bring up the Nifty intraday graph, and I think it just happened where we are pretty much at the day's lows, and we're worsening from that gap down that we started off with. The Nifty futures now at 22,335, 22,190 is where we're currently at. So just less than 200 points away from even breaching 22,000. But Manish, I mean, should one be buying right now, or is it like, catching a falling knife? Should one wait for the dust to settle down? Because valuation-wise, one would say that, we're getting to the buy zone already.
No, so absolutely correct. The perspective of a foreign investor invested in India, investing in India, vis-a-vis a domestic investor who is investing in rupees is very different. So just to put things in perspective, the CAGR of the Indian economy, the GDP growth in the last 12 years, that is 2012-13, Indian economy in dollar terms was 1.8 trillion. And in 26, this is around $3.57 trillion. So basically, for a foreign investor, the economic growth or GDP growth in nominal terms in India has been around 6%. And for a rupee investor, this nominal GDP growth in India has been around 10%. So, obviously the hierarchy is being played by the depreciation of the Indian rupee, and obviously the reporting currencies of foreigners are the US dollar or equivalents. And that is why they find it very unlucrative for investments in India. Keeping that aside, I think if you're a rupee investor, things have corrected massively. And I think today we are looking at valuations which were closer to around the COVID era. And in that backdrop, we all know how things play out. So it's very difficult to forecast the next 15 days because things are all over the place globally, and repercussions are going to get felt across the industry. But think a slightly longer term. India has been resilient. Yeah, we have seen that we are a domestic facing economy, and government comes in and expands deficit whenever the need of the hour is, and all of that will be supportive of growth. And in terms of 9 to 10%, because inflation is coming in on 9 to 10% GDP growth for India is good. And within that backdrop, some of the sectors and some of the companies where valuations have become mouth-watering from a 3 to 4 year perspective, one should actually be looking to buy. I'm not a seller at all, even though the FIs have been selling left, right, and center, and there's no hope that they would come in anytime soon. Domestic savings is replacing foreign savings, and that is basically how it's going to play out. So one needs to do one's homework, look at stocks and sectors where there is resilience, look at valuations, and then build your portfolio.
But that's the problem, Manish, because, while you know that the valuations are close to COVID levels right now, you're not really seeing that visibility anywhere. And now banks and financials, they as well, the back has been broken. And then you have these incidents like HDFC Bank, where there is then the trust deficit also comes in. And the highest weighted sector as well is getting collapsed right now. What's your preferred list in the market to buy?
So inflation is on us. Sectors which are exposed to inflation and benefit out of inflation are going to be outperformers. Commodities, or you can look at consumption where there's ample pricing power. Sectors which are dependent on government orders like defense, etc., where valuations have corrected. Now that energy prices are very high, there's a renewed focus on renewables. Of course, out there again, valuations have corrected, and not to do so much with the generation part of solar renewables, but more to do with the transmission and the value chain, the transformers and the oils and all of that go into the power value chain. Those things look good. I think the hospitals where there's absolute demand inelasticity, so to speak, these are some of the places to hide. As far as the financials are concerned, of course, the large private sector banks have huge exposure in terms of FII investments. Now, with the damage that is on us because of the war, two moving variables in the banking and financial space. One is your deposit accretion. That is one. Of course, we are not talking about Q4 numbers. We are talking about FY27 going into FY28. And the second is obviously credit cost. There's already some murmurs around the fact that government may be looking at a moratorium for small businesses, like the time we saw in COVID. All of that will have repercussions for the financial space. But having said that, I think valuations are pretty okay if you were to take slightly longer term. These are self-adjusting, the credit cost, etc., gets into the P&L over a period of time. And it's a very large sector. So selectively buying, if you are looking at specifically Q4 numbers, then obviously private sector is going to report around 7 to 8% sort of a profit growth, net profit growth. Because of bond losses for PSU Bank, this profit growth is likely to be around 3%, but valuations are just the reverse. The valuations are much more favorable for PSU banks as opposed to private sector. But yes, there is a pick and choose in that. There is correction across the board.
And Manish, I'm curious to know, it's a fast-moving and a very volatile geopolitical environment, and the impact on India is also likely to be substantial if at least there is one part of the market which feels that if at all this war were to prolong for maybe another couple of weeks. Give us your take. How quickly does this war need to resolve itself for no earnings downgrades on India? And even if it were to happen, what would the earnings downgrades likely look like? Will it be short term? Will it be something more medium term? What's the sense?
The situation is evolving, and as I alluded to the fact that the damage is already on us. It's not just a military event. It is an inflation-driven supply shock event. And the growth shock is going to move across the global economy on in which India is not going to be left out. So yes, India has been resilient in the past as well, but there will be some time lapse when the growth is likely to come back. So I think markets over a period of time will look at FY28 numbers now, because FY27 is a one-off normalization. If we were to build in, I mean, the war is not yet ended, but if it was to get extended, then obviously it is going to be through increased working capital. It is going to mean higher rates. It is because of inflation, and it is also going to mean compression in margins because of raw material. Second order impact is demand compression, consumption, getting more squeezed towards staples as opposed to discretionary, because there's likely to be postponement in that, and in that which is likely to be more preferred given the requirements is likely to play out, and whether the pricing power exists within the consumption spaces as well. So this is how likely the entire thing is going to play out. But I would reckon FY27, if we were previously working with 14 to 15%, at least a 2 to 3% damage to overall EPS estimates of FY27 is likely par the course, given where we are currently.
Manish, also, the learning from the previous fiscal, given that so much transpired and it sort of, the index alone tested your patience for quite some time. What are the sectors or themes that you would steer clear of right now as you build the portfolio for the next year?
So basically, all the sectors and themes have become, mouth-watering in terms of valuations. But supply chain bottlenecks, these are some of the spaces to likely steer away. There, where you have, you have lock-in on working capital for higher periods. I think the idea is not to depend so much on export-oriented sectors currently, merchandise exports particularly, and focus more on what is produced and consumed within the country. These are areas where one needs to focus on. Some of the areas which are high ticket items, because mass income is likely to get compressed. Inflation is going to eat into your savings. Real estate, these are high ticket items. They can always be postponed, so on and so forth. These are some of the spaces which one needs to be wary of currently, because these are sectors for the good times. When there's ample liquidity, when interest rates are very benign and low, and there is a lot of liquidity into the system. These are the spaces which flourish in those periods. But currently, we are not in that sort of a situation. You should likely be better off not owning them for the immediate near term. Of course, if you were to look at valuation, some of the real estate names also have corrected massively. So if you were to take 5 to 7 again, these are very good spaces to be in, but it all depends on the time horizon. Near term, obviously, they are headwind.
Manish, if I were to pull, and the typical retail investor would want to have maybe a 3-year to 5-year time horizon, very focused questions. One, is this a very good time to buy, given the fact that there is a risk to earnings over the next couple of years, which you've spoken about? And point number 2, if so, what are the best pockets?
No, so retail investor, 3 to 5 years probably, would be much better off buying at these mouth-watering valuations. We have seen time and again then that whenever it feels like that the world is going to come to an end, that is the point in time when you get the best prices in the market, no matter what the naysayers would be saying. And today we are in those sort of a situation, in the current times. COVID was the last time when we saw these sort of valuations. Of course, we have seen the resilience of India time and again. So from a 3 to year perspective for a UHNI retail investor, it's a great time to buy. It's not the time to park your money in FDs. You should go all out and buy, provided your time horizon is 3 to 5 years. Second is, you should look at earnings power of companies and valuations. Obviously, these are the two major important things, because we are today in an extraordinary situation. This is not a normalized situation. And the earnings power should come into the question, where you have to analyze the competitive advantages of companies and how the things will come back once normalization happens. So in good times, strong companies defend their margins very well, even though volume collapses. And in bad times they defend their margins, and in good times they defend their growth. So currently, since we are in for tough times, we should look out for strong margin retention in companies which have a good visibility from the next 3 to 4 years. So defense, commodity, these are likely to, and valuations are not very demanding across the space. So I think a mix of consumption, savings, investments is part of the course, but keep it very focused on good valuations. Extraordinary valuations, extraordinary companies bought at insane prices also would not make money. So that's how we should build it.
Right. Well, time to buy the fear. That's the message coming in from Manish Sonthalia. But of course, don't blindly get into it. Do your research, see where the growth visibility as well is. Manish, so great having you today on the show. Thank you so much for your time. Okay, on that note, let's wind it up right here on this edition of The Market. Thanks so much for watching.